The term financial market refers to any marketplace where securities or contracts are bought and sold. A marketplace is an area where people can buy and sell things. You can imagine this as a physical area or location, but this is not typically the case for financial markets. While there are financial exchanges, which are physical, you and anyone else who wants to participate can do so from the comfort of their own home. So there are a few financial markets that we are going to cover, and with that, we are going to be separating them into 3 different categories. That is going to involve securities, derivatives, and currencies. First, let's review securities. A security is a financial instrument which holds some type of value and can be liquidated or sold freely. Under the securities category, we have equity or stock markets and bond markets. Equity can be defined as a percentage or portion of a company's stock, which can ultimately provide shareholders with capital gains. Equity markets or stock markets typically involve the purchasing and selling of fractions of the company, otherwise known as the underlying asset. I will also preface that the money you make off of these positions will derive from the direct change in the stock or value of the company. Some popular equity markets include large corporations such as Apple, Microsoft, Tesla, or Meta, but is quite a large sector overall. The Nasdaq, which is one of the largest stock exchanges in the world, has nearly 4,000 different stocks listed as of 2024. Note that these are all publicly traded, meaning that anyone can participate in the trading or exchanging of these stocks and shares. One expectation you should consider when going into these markets is that you will typically make very little in regards to how much capital that you have. This is because stocks don't really move that much in a given day in relation to its total value. The S&P 500, an index which measures the performance of the top 500 most valued companies in the US, will typically move between 0 and 1% in a given day. This index acts as a fairly accurate representation of the overall movements within a market, which we can use to determine the average movements within the stock market. So 0 to 1%, this tells us that stocks don't really move a great margin, so you can expect that in a market that moved, let's say 1% in a day, you would be making $1 on a $100 investment at best. Remember, the proportional price movement within a stock is the exact same proportion that you will see in your position. So let's say you bought 100 shares of Apple at $170 each and sold at $172 each. This means you had earned $2 from each of your 100 shares, which is a gross profit of $200. On the 100 shares that you purchased, you used $17,000 of capital to make that $200. This would of course be the quantity of shares that you purchased multiplied by the share value of Apple, which is $170. So, $17,000 to make $200. While this isn't necessarily bad, you can do much better in other markets, which we will go over shortly. It also doesn't really matter if you have a lot of capital to trade with. Now, of course, this won't necessarily apply to everyone. Not everyone has $17,000 that they could just throw into an account. But if you do have that much money or much more, then you don't really have to worry about the actual maximization of your capital. Another feature of equity markets is the offering of organic price action. Remember, price action is the movement of price or the candlestick charts. What I mean by organic is the fact that there are no externalities that influence price, aside from typical market events and participants. Other markets, such as the derivatives markets, which we will review shortly, have many factors which can change price, such as the change in time. Equity markets do not have this. With this in mind, we can conclude that equity markets are quite safe as compared to other markets. We can also conclude that it is much easier to understand price action within equity or stock markets and how your positions will move. Once again, when there are less variables involved, it is much easier to understand and interpret. Another component of equity markets is the enforcement of the PDT rule or lack thereof. The PDT rule, otherwise known as the pattern day trader rule, restricts the trader from opening new positions if they open and close more than 3 within a given week. To put it a bit simpler, if you enter and exit 3 positions within a week, your account will essentially be locked from trading until next week. This may or may not be a problem for you, depending on what strategy you take on, but either way, equity markets do not enforce this rule. I will repeat, it is not enforced when trading stocks. This means that you can place as many trades as you please when trading stock. Now, if this rule was hypothetically enforced, there is one more requirement before it is enforced. That is that this rule only qualifies for trading portfolios or accounts with capital less than $25,000. So, no matter what market you are in, if your account value is greater than $25,000, you never have to worry about the PDT rule ever. Although, your account has to remain above or at $25,000 at all times. Right when your account is reduced below this level, then the PDT rule will be enforced. One last feature of equity markets that I would like to mention before moving on is the high liquidity that it provides. Equity is traded, invested, borrowed, and moved at a high frequency. This allows the trader to enter and exit positions freely and limits the amount of slippage that may occur. Slippage can be defined as the difference between your anticipated entry and where your position is actually executed at. Now, you would think that these would always be the same, but they actually may not be depending on the slippage or lack of liquidity that may be within a given market. This might be a bit confusing. If you want to skip ahead and go to section 5 on types of orders, I will go in more detail on slippage. Bonds can be defined as an agreement between a borrower and a lender, which typically involve a government-issued loan which returns the lender their initial investment plus interest. Bonds compare and contrast with equities in many different ways, but we can begin with talking about how they are similar. So just like equity, bonds generally require a substantial amount of capital in order to realize a fair profit. Also similar to equity markets, bonds are very safe, generally speaking. Something you will recognize throughout any form of investments is that the risk and return typically correlate positively. As the risk increases in a specific investment, the potential reward is likely to increase as well. Similarly, as the safety of an investment increases, the potential reward is likely to decrease. You may have heard this quote from Thomas Jefferson before, but he puts it very well. With great risk comes great reward. A popular bond that investors like to take on are government-issued bonds. This is because they are extremely safe and are probably some of the safest assets you can invest in the entire world. This is because the government is very good about paying people back, in context, but as we had mentioned, as the risk is reduced in an investment, the reward reduces as well. Government-issued bonds typically provide very low returns. You can expect interest rates between 2 and 10% from government bonds, and they'll typically last a few months to many years or potentially decades. Another benefit to bond markets is that there is no PDT rule when holding bonds, as these positions almost never last any shorter than a week. I also want to mention that bonds are more so a form of investment rather than a trade. You don't typically trade bonds, but rather invest in bonds. Again, I'm reviewing different financial markets here, which is not necessarily restricted to trading only. If this is rather confusing, bond markets are really not for trading at all. In fact, you can identify bond markets more so as a form of collateral than anything, which can act as a hedge to your trading portfolio. In other words, you can use bonds to keep your total account value more stable, as trading may involve inconsistencies or ups and downs. Since bonds are rather safe and require very little maintenance, they are a great asset to help diversify your portfolio and mitigate the risk involved with trading and other financial instruments.